This is the second time that I've done that. Oh my goodness. Thank you guys. Second time that I've done that because I put my microphone on mute while the music plays. Not that I need to, because the way it's set up is that it shouldn't pick up the microphone, but I put it on mute just in case. And then lo and behold, I forget to turn it on when I start talking. So anyway, hello, thank you. What I was saying was I see Rands and Senses here, and hopefully this time the content is a bit more advanced for you. I don't know if we'll manage to get through all of it. It seems very simple and short, but it's not necessarily that easy. Well, I don't know. We'll see. We'll see how it goes. Yes, Heinrich, I am starting a bit late this evening, so I'm trying to figure out which time is the best, because I know that some people have like kids they have to put to bed and all sorts of things, so it's not always easy to, well, I'm trying to figure out what the best time is to put this on so that we can obviously get the most guys watching. So I'm going to be moving around the time, probably for a couple of months until I settle on a good time. So we did 7:30. We did 7:45. Now I was going to do 8:30, so I pushed that out to 9. So we'll kind of figure out where the sweet spot is to get the most people involved. Ideally, obviously, we'd like you guys, or I'd like you guys, see the proverbial we, would like to get you guys interacting on the Discord channels, on the YouTube chat, wherever else, so that we can get some conversation going and get things moving on. So in any case, all right. Let's look at what we are going to be looking at tonight. I see Amatola trying to pick bottoms. What can you expect to stop this behavior? I'm 45 at the moment. Okay, so okay, we'll get to that, Amatola. That's somebody on the Discord. All right, so let's get to what we are going to be talking about this evening. Dun, da, da, da. Once again, the fancy, sexy, non-presentation mode Excel, Microsoft PowerPoint, whatever it's called, is our tool. So I was going to talk about the what do you call it, slow stochastic, or just stochastic in general, and I was also going to talk about like a on-balance volume indicator, OBV, but I decided not to do that because the stochastic gets a little complicated with the maths, and I think that if I spend 6 minutes per slide, we're at 1 hour, and if I so if it gets long-winded explanations, then maybe we might not have enough time. So I'd rather stick with the stuff that I know we can get through. So, all right, okay. So moving averages, we're going to be covering two things this evening: moving averages and oscillators. There are two different types of moving averages, being simple moving averages and exponential moving averages. Now, I'm sure most of you are familiar with normal moving averages. You put on an MA or a moving average. That is a simple moving average. You put on an EMA, and the moving average looks a little bit different. So we're going to be looking at like how those are calculated, and then we'll be looking at some simple moving average strategies that you can trade on that as well. And we're going to be doing this sort of using live examples. So I would like to get from you examples of charts to use, because I haven't got a bunch of examples. We need this to be interactive, so I need you guys to give me examples of charts you want me to look at. Then we're looking at oscillators after that. So we're going to be looking at the MACD oscillator, which is called a moving average convergence divergence, or MACD, and then an RSI, which is a relative strength index. And then we'll be looking at some strategies on how you can trade those. Again, looking for examples and charts from you guys to be able to do that. So we're going to jump straight into moving averages. So what is a moving average? A moving average basically is a line that is plotted that plots the average price of a security over a period of time. So it basically adds up the closing values for a number of periods and then divides it by that number of periods. So if there are 10 periods or 7 periods or whatever moving average you're using, it adds up the closing price of every single one of those periods, days, hours, whatever, and then divides it by the number of periods. It then plots that line, or plots that point on the chart, and it just does this every day on a rolling sort of scale, and then it sort of draws this line as we all know moving averages, right? And what we can use moving averages for is as a trend indicator, and it can also show support and resistance levels, right? So it shows us potentially where support and resistance levels are. Now, we spoke about support and resistance a while ago in one of the earlier videos, and there looking for those support resistance levels, there's different methodologies that one can use. Moving averages do a good job at creating dynamic support and resistance levels, ones that move, in other words. So starting with a simple moving average, let's assume we have daily closing prices of 11, 12, 13, 14, 15, 16, 17. Basically what it does is it calculates, let's say we're calculating a 5-day moving average, it adds the first 5 days together and divides it by 5 to give us the average, and it does this every single day. Okay? An exponential moving average is a bit different. So I've actually got, let me just, I shouldn't do that, I keep forgetting. Let me just quickly find this fancy schmancy spreadsheet that I've made for you guys. Ta-da! Alright, so what we have here is an example of, I'm going to hide all of this data. Hide. Bang. Alright, so what we have here is a data set of 100 points of data. Okay, above my head here. 100 individual data points. Okay, I can hide this as well. So on day 1, price is 10. On day 2, 10.2, and so on and so on and so on for 100 individual days. And that draws this fancy line here, or this fancy chart that we have here. We can mess around with the axes and make it look a bit better, but whatever. This gives us, actually, you know what? Let me do that. Format axis, and we just want to give it a minimum. Let's say the minimum is 9.5. Okay. So this gives us a nice little chart here, and we can see that this chart gives us a nice upward sloping trend, right? So here we have 100 data points which draws this chart. We want to now work out what is the what are the moving averages here, or how do we calculate moving averages? Okay, so I'm going to start by just doing just that. Okay, and all of these I'm going to make white so that you can see them. Boom, like John Cena. You can't see me. Alright, so what we are doing here is a very simple calculation. As I explained in this slide over here, we are basically just adding together the number of days that we want for the moving average, and we're dividing it by the number of by that same number of days, right? So we're adding up the closing value for each day and we're dividing it by that. So here we run a very simple calculation. We want to put a 7-day simple moving average on. Perhaps I should zoom in so you guys can see slightly better. That's like disgustingly big. Is it ever going to stop? Okay, we want to put a 7-day moving average, simple moving average on. Okay, so what we do is we take the first 7 days of data, we take those 7 days, we add them together, and we divide them by 7. And over here I've got that formula in, which is basically, I'll show it to you here, the sum of this range, or this range, which is those 7 days, divided by 7, gives us that point, right? And we basically just use that formula to calculate a large data set, and that plots us a moving average. So what we can do, I went too far. Oh, you went too far. 1, 2, 3, 4. All right. So what we can do is we can then plot that onto our chart over here. Okay, and that gives us this nice moving average that we can then use in order to give us signals of trend. So basically what we are looking at is if the price is above the moving average, the trend is up, and conversely, if the price is below the moving average, as it is here, the trend is down, right? We all know this stuff. This is not new. Then to calculate a 21-day moving average, we want to use pretty much exactly the same calculation, just now we're using 21 days of data. So you see my first data point here on the 7-day moving average can only start on day 7, right? Well, day 8 technically. Well, day 7 because it uses the closing price of day 7. On the 21-day moving average, the same applies, same formula, just now we're using a bigger range. We're using 21 days of data, and we're dividing that by 21 in the end as well, and then that plots us our very fancy 21-day moving average. So let's just include that in our chart, and pow, oh, this is a mistake that I made. I'm gonna do, sorry, 21. Ta-da! There you go. Okay. So this shows us our 21-day moving average. So now, a very simple strategy here, while we're at the 721, is to trade a 721 moving average crossover. Right? So when the 7 and the 21 moving average cross, then you have a buy or a sell signal. When the 7-day moving average crosses the 21-day from the top down, as it does here, so 7 is at the top, 21 is at the bottom, it crosses down, you have a sell signal. And conversely, when the 7-day moving average crosses the 21 from the bottom, you have a buy signal. Okay, so it's not quite that simple, and we'll get into moving average strategies and obviously a little bit later. But this is just to illustrate how it works. Okay, simple moving average, very simple. That's why they call it a simple moving average, because hey, they're easy to calculate. Who would have thunk, right? Then the exponential moving average, ironically not exponentially more difficult to calculate, but does not necessarily, I mean, it's got a bit of a trick to it, right? So what does this exponential moving average do? What it does is it applies a weighting to more recent prices rather than later prices. So what, in other words, what that means is that the more recent the price is in the data set, the more important the exponential moving average considers it to be. Okay, so a couple of things happen here. When you use longer term time frames, that weighting or the importance of newer data is less important than older data. Okay, when you use shorter time frames or less data, the newer data is considered a lot more important than older data, and it does this with a mathematical formula. All right, so there are 3 steps to calculating it. First, well, I suppose the order of these you can exchange number 1 and number 2 here. I guess it doesn't really matter. But what you do is you work out the weighting multiplier. So you have to first work out what the weighting is that you're going to give new data. Then you have to calculate a simple moving average, because you've got to start your exponential moving average somewhere. I'll explain that in a second. And then from there you can calculate your exponential moving average. So let's look at the calculation. Your initial simple moving average, let's use a 10-day period. You calculate the 10-day period sum divided by 10, and that gives you your simple moving average. We just did that with a 7 and a 21, easy peasy, right? Then you have work out the multiplier. So the multiplier is 2 divided by the time periods plus 1. So in this case, we are using 10 time periods. And that means we are saying 2 divided by 10 plus 1, aka 2 divided by 11, gives us 18.18%. Right? Then to calculate the EMA, or the exponential moving average, you take the closing price minus the exponential moving average of the previous day, multiplied by the multiplier, which is what we just calculated out here, and then add the exponential average of the previous day. Okay, so I'll go through that again. The exponential moving average, you calculate by taking the closing price minus the exponential average of the previous day, work that out, multiplied by the multiplier, and then add the EMA of the previous day. Okay? So let me show you what that looks like. Ta-da! Enter the EMA, the 10-day, I worked out a 10-day SMA here, simple moving average, for the purposes of illustration. What I'm going to do is that. Okay. Sorry, I didn't think this through actually, because that tends to be something that that I do. Okay, so what we need is that data range. Come on, all the way down. So, what did you guys do today? We need that data range, and we need. How do I do this? There we go. On Mac. Why must Mac be so difficult? And that data range. Pow. Okay. Ta-da. Oh, right. Don't want number of days. We're going to delete that. Okay. So here we have now the price and the 10 period moving average, right? 10 period simple moving average. So now for illustrative purposes, we're going to work out the multiplier, and we're going to work out the EMA. So the multiplier in this case, as calculated before, gives us 2 divided by 10 plus 1. Okay, so that's fairly simple to calculate. And we see that that works out to 18.118. And this is way too small for you guys to see, so I'll make it slightly bigger. Okay, cool. So that gives us, this is our calculation, right? 2 divided by 10 plus 1 gives us the multiplier, because we're working out a 10-day exponential moving average. Step 1 is to work out that multiplier. Step 2 is to work out a simple moving average. So we're using the same formula here, which is 10 days all added together divided by 10 gives me, in this case, 10.97, right? So that is equal to that. Then to calculate my exponential moving average, I am saying I want to calculate the closing price of today minus the closing price of yesterday multiplied by my multiplier, multiplied by my multiplier plus yesterday's closing price. Okay, so I'm going to run through that again. The price, today's closing price, minus yesterday's exponential moving average, right? Multiplied by the multiplier plus yesterday's exponential moving average. So yesterday, in the first point of the data series, it's not yesterday's exponential moving average because it's SMA, but this formula carries forward, and then we get this effect, right? And then from here, what you do is the following. I'm going to completely select this all again. In the yellow submarine. Give me just a second. This is now looking all dirty. Jeepers creepers, man. How much can you struggle? I'm going to just delete this chart. Okay. So what I'm going to do is I'm going to hide these. Hide. And I'm going to take I'm just going to start it from here. Sorry guys, I'm having an acute case of the user error of the user. There we go. Pow. Okay, so what we have here now is an example of the exponential moving average versus the simple moving average, right? So here, blue is once again price, okay? Time series 4 in this case, if we look at the chart, sorry, just making it smaller so we can see, time series 4 is the green line, is our exponential moving average. So we notice a few things, okay? Let's do that rather than making it bigger. let's change the, come on man, format access, let's change our access to our minimum 9.5. Bang. Okay, so what we'll notice here is that our exponential moving average tops out before our simple moving average, and it bottoms out before our simple moving average, and the simple moving average actually goes lower than the exponential moving average. So what's this exponential moving average is doing is it is putting more weighting on the more recent data than the older data, right? And therefore it is able to respond quicker. So if we use even more data, let's make that black again, then we are using, let's say we're using 21 days, which is the case in this column here, so we only start at day 21. We run our same equation, which is 2 divided by now 21 plus 1, right? Okay, go away. See, net traffic software. Oh. Okay, and then that gives us a 21-day moving average. But now what happens is the weighting factor, or the weighting multiplier, is different, right? Because we're using more days worth of data. We can change these to percentages if you like. So instead of having an 18% weighting to the newer data on 10 days, on 21 days, we now suddenly have a 9% weighting. So what's going to happen is that for every time that the number of days double, the weighting of the most recent days halves. Okay, so if we then add that into our series here, we get our 21-day exponential moving average. Ta-da! And that's really the difference between these things. So what is the goal of an exponential moving average? The goal is for it to react faster than a simple moving average, and therefore it's more accurate. Okay. Again, it should be said that the more data you have, the more accurate it becomes. So there are a couple of schools of thoughts. One, you can't really work out an exponential moving average with less than 10 days worth of data. Two, exponential moving averages are only really accurate if you use it since the inception of the security. So from day one, you use every data point from day one to work out the exponential moving average. I get that this isn't always possible. So the rule of thumb in general is that you have to use more than 250 data points. So 250 points of data, 250 days, 250 hours, 250 5-minute periods, whatever it is that you're using, right? And then yeah, so pros and cons of using each. Simple moving averages are slower to react. They indicate support and resistance slightly better than the exponential ones, and exponential moving averages react slightly faster, but they're not ideal for support and resistance. I'm going to have a look if you guys have any questions up to this point. It would be great if you did. So what I'm going to do here is I'm quickly going to cover, well, not quickly, I'm going to cover some different trading strategies, and I'm going to click my neck. So I hope none of you guys get freaked out by that. Okay, so what I'm going to do here is I'm going to put on a, let's put on an EMA. Oh, EMA, okay, let's put on EMA cross. Okay, so what we're going to do, actually no, we're not going to put on an EMA cross, we're going to put on a SMA cross, SMA, so, moving average crossover. Okay, what we're going to do, see that's automatically set to a 926 moving average crossover, but we can change that to a 721. Disclaimer, this is Simon Brown's system. Well, I don't know if he would call it his system, but it is definitely his one of his ways of doing stuff. It works good on 1 hour, 4 hours daily, better on shorter term time frames, ironically. Anyway, so what we want to do here, I also want to make these nice and thick blue so you can see them. Not that thick, that's nasty. And we're going to make them blue and pink because we need them to really stand out. Light blue and pink. Oh yeah. Okay, so basically what we have here is a very simple moving average strategy, which tells us that every time that there is a crossover of these two moving averages, I'm looking at Tiger brands, by the way. I'll make a note here, TBS, so I can remember which stocks I use in the videos. It's just by chance that this was Tiger brands. We can use any other stock that you would like, so if you have any suggestions, please let me know. So in any case, what's happening here is that, or the basic strategy here is that every time that there is a 721 moving average crossover, we have a buy or a sell signal. It's really that simple. You could add different things as well. So for example, you could add a daily close. So let's zoom in and take some examples, right? So let's say you were trading this sort of crossover here. The crossover happens on this day. You can see there it's got a little plus sign marked to it. I just want to check, guys, am I streaming in HD? Can you see these charts? Can you stream these charts? Okay, I think I am streaming in HD, so you should be able to see them. Okay, so here you have these crossovers, right? And what you're looking for is you're looking for this crossover, and then that crossover is going to take place there, but you're only going to see it at the bottom of this candle. And then what you do is you wait for the next candle to close below your trigger candle, which would be that one, and that then confirms your short. Okay. Conversely, if you're taking a buy signal, this candle here is the one, sorry, this candle here, I'm going to use lines. This candle here is this is where the crossover takes place, right? This candle here is the one where you're going to see for the first time that there has been a crossover, and then you need a daily close or a period close above that candle's close, which is this candle next to it, will then be the candle which gets you to go long. That makes sense? Questions? Okay, you can use different stop loss strategies here. Do you put it at the previous low? Do you use the trailing stop loss? Do you use another crossover of the moving averages to get you out of the trade? Yeah, there's a variety of different ways that you can manage risk, and you'll have to pick from the different risk management sort of what do you call it, like toolbox, tool case. Obviously, as time goes by, we'll get into more risk management stuff. So you know, for now, let's just focus on this as picking entries. Let's say what you can do here is you can measure something called average true range, ATR. You can put average true range on. You can measure average true range at the day of your entry, which if you look here is 1,440 round up 3 cents, or 14 Rand and 43 cents. You multiply that by 2. This is 14 days average true range, right? You multiply that by 2 and you say that that is your trailing stop loss. And then you say, what does that work out to? 29, call it 29 Rand below your entry, which is the close of this candle, and you stop loss at 29 Rand below this. Where is this minus 29? What is the closing price here? Give me a second. Closing value here is, I'm just going to do matchbox maths here. Closing price is 83, so minus 30 is going to take us to 53, 20, 54, right? So we're going to close at 54. Bang. So there's our stop loss over there. Okay. Alternatively, what you can do is use another moving average crossover then as your sell signal. So your moving average crossover then takes place, the next moving average crossover takes place over here, but you'll only see it on the next day because that's just the way that the signal kind of works. And then once you see that moving average crossover, you would then stop out. Let's say you take a day to stop out because you have to wait for the signal to confirm. and then you stop out in this day here, so you would stop out at 271 in this case, which isn't so far from where your entry was. But at the same time, you now have a sell signal to sell at 271, and again you use average true range times 2. So average true range in this case is now 11 Rand 30, so call it 12 Rand, so 24 Rand, and your closing price here is 73. So you're gonna make that kind of 96. Right, so your stop loss is going to be here, which is almost the same as the highs here, and then you can use that as your stop loss, and or you'll trail that distance down with the stock all the way down. So as price goes lower, that stop loss comes down with it until you get another moving average crossover, or you get taken out. And in this case, you would have had a beautiful short here on Tiger Brands in that situation. Here, you'd be short again. That might have gotten you out, put you short again. So sometimes it can whipsaw you, but every now and then you get really nice, big, long moves where you have, this nice smooth ride. But as you can see, the more data you look at, the more you have kind of like whipsaws and whatever, especially in sideways moving markets, you get killed. Nice long trending markets up there, those are good trades. There it hurts a little bit, there's a good trade. There it hurts a little bit, it's a bit choppy. There's a decent trade, a bit choppy, decent trade, decent trade, decent trade. So, every system has its pros and cons. So that is a very simple 721 day moving average crossover. The next one is a nice moving average crossover system as well, more of a trend indicator system. So what cancel. So what this is basically is like a medium term trend reversal signal, right? So you use a 50 and a 100 day moving average, and then you add a 200 day moving average. Boom. And you can take the ATR away. So let me just specify here. You're going to have to go through which type of moving averages work best for you. There's obviously a very clear difference between exponential and simple moving averages, but you are the one that's going to have to make the decision on which one works for you. It requires some back testing, it requires some time for you to look at the stuff, the periods that move for you, all these things. Remember, these are just tools. At the end of the day, you are the analyst, and you are the one that has to go and test systems and look at things and see, does this work, and back test it and sit and go through charts and painstakingly write down entries, exits, see if the system works. Come up with something that the more systems you test, the more you'll figure out like what works and what doesn't, right? Unfortunately, there's no shortcut. There's no way of saying that this is a strategy and this is going to make you money, because the truth is that strategy might make somebody money because that strategy was designed by that somebody in order to suit their individual personality, and therefore they have the discipline to execute that strategy in accordance to that strategy's rules. You cannot, whether or not that's going to work for you is debatable. At the end of the day, you could follow a system or a strategy that works perfectly, and you'll find that it only works for a period of time and then it stops working. And that is because the market is dynamic and constantly changing. So as analysts, technical analysts, or any kind of market analyst, we have to find our own way of doing things. So which moving average is better? I don't know. You got to decide. I can't tell you that. That is completely 100% up to you. So, all right, let's add a sexy yellow line here, and we're going to make it nice and thick. And we're going to say that this is a medium-term trend indication system. All right, now you can run this on a daily or on a weekly chart. It really depends on you. What the basic premise is here is that we have we're looking for a medium-term trend change, and we're using longer term moving averages in order to do that, right? So we're looking for a bullish crossover of the 100 and of the 50 day and 100 day moving average while price is underneath the 200-day moving average. Okay, so a bullish crossover means that the 50 moving average is crossing up through the 100-day moving average, right? While the price is below the 200-day moving average. And you can go back and you can test this, and it works quite nice. So over here, you can see there was, so in this case, my moving averages are the 100-day moving average is the little purpley pinky line, and the blue moving average is the 50 line, and the sexy yellow one is the 200-day moving average, right? So in this case, we are in a bear trend because my short-term moving average is above my, is below my longer-term moving average. So the 50-day is under the 100-day, and the price is underneath both of those. So that's a bear trend, right? Here we have a bullish crossover where one price moves up through our moving averages. So we have price above moving averages. Then we have a short-term moving average crossing up through a longer-term moving average, which is a bullish crossover, while price is obviously moving up. Now, what's happening is this crossover takes place while, and I'm going to zoom in here to this particular moment in time, while this crossover takes place, while price is okmar net underneath our 200-day moving average. Now that is going to be a longer term or a medium term trend changing signal for us. So this is for guys who want to trade daily charts and don't mind sitting in trades for months at a time, right? Or I suppose you could use this on 1 hour charts as well, or you know, whatever. It's a chart's a chart, right? So this is a relatively strong buy signal. You can then also use whatever you know, stop loss strategy it is that you decide to use. Average true range is a good one. You know, using the previous lows is also a good one. It really depends on what your preference is. But here we see that this is our entry, so I'll mark it here. There's our moving average crossover, right, on this candle. So the next day we only see it. So there's our moving average crossover. For uniformity, I'm going to make this blue like the previous one was. Right. There's our moving average. There's our moving average crossover. And then we would enter into the trade, provided that it is still below the 200-day moving average on this day. And we're going to make it yellow. Right. So there's our entry. And then basically what we're looking for is an exit price is another crossover of my 100-day and 50-day moving average, and we can then ride this trend. Oh yeah, boom, there's our crossover. Okay, that one almost entirely wiped out most of your profits. So a trailing stop loss in this case would have worked nicely. So ATR, average true range. At time of entry, the ATR reading was 7 Rand and 6 cents. So let's call that 7 Rand 10 cents. So we're looking at 14 Rand 20. So at any point, if this thing has moved 14 Rand 20 against you, so from here, it was, what was the close? 279. So let's call it, what is that? 75.65. So our stop loss would be 65. All right, that's close enough. So our stop loss would be somewhere around here, which is this little blue line over here. And as price moves up, it would trail. Now, odds are it would probably take you out in one of these pullbacks here. All right. So it, I mean, I honestly don't really want to go through it and do it absolutely pedantically at this point. But, you know, as you can see, here was a decent signal. It rallied up, and conversely you have a crossover, and you know, when price is above, it doesn't work so lacquer on the short though, so be warned. This is another one. There's a fairly decent signal here, but you probably would have been stopped out. This is just too noisy, so you can't trade this. Unfortunately, you lose a very big opportunity. There's another bull signal, gets you up here. Then we have this beautiful long downtrend, and guess what we have now on Tiger Brands, ladies and gentlemen? We have a bullish crossover of a 15-100-day moving average, while price is underneath 200. So this tells me that we have the potential of a longer term trend change scenario on Tiger Brands. Any questions thus far? Okay, there is one more moving average strategy that I want to cover with you guys. I just want to make sure that I go away. Let's take off all my drawings. Alrighty, so there is one more moving average strategy that I want to cover with you guys, which is pretty simple. It's also a longer term one. I'm going to put 3 moving averages on. The first one is going to be a 89-day moving average, and we are going to make it, what are we going to make it? We're going to make it yellow, because yellow is lacquer. The second one is going to be a, what are my parameters here? A 10-day moving average, and we're going to make it green, because green is good. Okay, and the third one we're going to make red, because we can, and we're going to put it at 20 days. Oy, and we need to make it slightly thicker. Cool. All right. So what we have here is also a sort of a medium term kind of moving average signal system, if you will. Again, you'll have to change these moving averages to suit whatever stock it is that you're doing, because sometimes the 10 and 20 might be too tight, sometimes it's not. It really depends. Okay, but let's say, for example, we're just going to go back in history here. We are looking for 2 things. Our yellow line here, our 89-day moving average or 89 period moving average, we're going to use as our trend indicator. This is the line that tells us which direction the stock is trending, because it is a very long term. It takes 89 days or 3 months worth of price data and averages all of that out. So if price is above 3 months ago or 3 months average price, then we know the trend is up, and conversely, if it's below, we know the trend is down. So in this case, we are looking at a crossover of price above that 89-day moving average. So literally, that is all we're looking for in the beginning, is a crossover of price moving up above through the 89-day moving average. Okay, so we can see here is one. Okay, it's a bit noisy. It comes down, crosses again, comes down, crosses again. But what's interesting here is that you'll see this relationship that it's got with the moving average here is something called walking the line. Okay, so you can see how this moving average offers like resistance. You know, price comes up against that moving average, kind of breaks through it, and if you look very carefully at the closing price values of these candles, in fact, you can even take this candle into a line chart. Okay, now we just got lines all over the place, and it's very confusing and ugly and terrible to look at. But if you look at this, you can see that we tried this blue line here, tried to get up above through our moving average, failed, found resistance, tried to get up above there again, just couldn't quite make it, and then eventually broke through, and then suddenly when this moving average now came underneath price, it managed to hold a support. Okay, so this relationship where it walks on either side of this line is where it's like busy testing that support resistance level. It's busy walking the line. It's busy seeing whether or not which side of this line it wants to be on. And that kind of relationship there then kind of tells you, okay, this is a significant level. Now, another couple of things that stand out here. One, you've got a horizontal support level over here, which then you can see got smashed through, boom, was resistance, 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 resistance all the way through, and then a break and support. Okay, so now you've got that polarity change between support and resistance happening at this call it 300 Rand level, plus you've got this walking the line situation. Okay, so you've got a couple of things to tell you, like, hey, maybe the trend is changing here, and that is what the what this 89-day moving average is trying to do. Okay, so once we have a price movement up above the 89-day moving average, what we want to do is we want to buy some stock. Okay, so that is our first entry. We see the crossover of the price up above 89. That is the first time we buy shares. Okay, we take a small position in stock. So let's say we've got 1,000 Rand. At this point, we buy 100 Rand's worth of shares. Then, as price moves away from this moving average and back to this moving average, away from the moving average and back to the moving average, it's going to form a relationship with the shorter term moving averages. So just off the bat, this looks to me like the 10 and 20 is too short. So I'm going to change the 10 and 20 to, let's say, a 20 and a 30. All right, so this even then still gives me a couple of nasty crossovers, but it's okay. So what I want to do here is the first time that we have a crossover above this price, that one might not have been so convincing, but this one surely would have gotten you in, all right? What you can do here is you can say that if we have a crossover back below this 89-day period moving average, you stop out. So here, you stop out. Then you get another crossover above. So you go long again, right? What you want to do now is every time the price pulls back towards this 89-day moving average and enters into the area between the 20 and the 30, or you can even, on this particular stock, that looks like the area is a bit tight. So you can make it a 20 and a 40. Every time the price enters into the middle of these two, you want to add to your position another 100 Rand's worth if we're working with 1,000 Rand, right? So the price moves down into this, and you can literally have your orders waiting in between. You can see, okay, this moving average is at 306, that moving average is at 316, so I need to be exactly in the middle of these two moving averages. And you can have your order waiting there, and if it comes and picks you up, then you're off. And you basically have an order waiting in that thing for 100 Rand's worth of stock all the time. Every day you set your thing there, and then you build into your position as the stock is moving in your favor. If you get a close below your yellow line, you stop out, right? Below your 89-day moving average. If you get a crossover of your two shorter period moving averages, you stop out. Okay, I see Yaku is asking a question on the Discord, so I'm looking forward to seeing what that is. Here we have another example, and probably a much better example, because here we have a proper trend, okay? So you have a first entry, and then a stop out. Then a second entry, then a stop out. Then a third entry. Okay, cool. This time we're actually in it for real. So you might have to find a way to to be more discerning with your entries, or you have to use a stop loss strategy that's not necessarily crossing this 89-day moving average. Maybe using an ATR times 2 again, or maybe using a previous low, or whatever the case is, whatever your stop strategy is. In these trend following scenarios, 2 previous lows ago is usually the best. So if you enter here, you would say that would be your stop loss at below there, because that's a previous low. 2 previous lows ago would be, well, about that same level, because it looks like it may have made a double bottom over here, right? Alternatively, you can stop there, but that is like a mighty long way away. So you could probably use that one, right? And then every time that you have price move in between your, in this case, 20 and 40-day moving averages, you add to your position, right? So you buy some over here, comes in here, yeah, it doesn't quite come in here. Definitely, you have an opportunity to add to your position. Runs up, comes back, add to your position. Runs out, comes, add to your position. Runs out, comes, add to your position. Runs up, comes back, add to your position. And then eventually you get a crossover and you stop out of your entire trade, right? Does that make sense? Let's see if we can find another example. Give me a stock. Let's use Firstrand. It's always the go-to, right? This is like way sideways and choppy and messy, so I would not suggest that you trade any signal. If this thing crosses over here, don't trade that. You can see here that it's just too messy, right? So you need to wait. You know, the sad thing is that at some point it's going to give a signal, and it's going to be the one that's going to make a trend in a direction, and then you're not going to be in. So manage your risk, right? If you do take a sort of directional trade here, maybe look for a crossover or a break of this range. You know, maybe this is not the right type of indicator to use for this particular setup. What is our view on MA channel, like 10 EMA high, 8 EMA low? When price close above 10 EMA, sell below, right? Please send me an example, Yaku. I would love to see what you mean. Brent is busy answering, so let's have a look. Okay, so Firstrand, Off the bat, I don't think that's the chart that I want to be trading with this particular thing. What has been trending really nicely? Sipanya. Okay, here we go. There we have our first entry, and we would have added there. We almost got stopped out. We would have added there, and bang, we got stopped out. All right. Then we have walking the line. Walking the line probably would have gotten in there. Stop loss over there, or there, or there. Probably stop loss in this sort of area because we got in here. So stop there, and then we would be still kind of in, and here we would have an opportunity to add plus another confirmation, and boom. So now we're waiting for a pullback for this area between here and here, but maybe in this particular case our 20 and 40 is too long, so we can mess with it. We can kind of see where the sweet spot is to be able to follow the trend as closely as possible, but also get a signal to stop out at the right time. And you may have to change it from a 10 to a 20 to a 30 and whatever. Just mess around with it. It depends on the volatility in the stock. It depends on the liquidity in the stock. It depends on 1,000 different things that is going to influence how this works or not. There's nothing wrong with messing with the parameters a little bit here and there, because that is the job of an analyst, is to find a system that works. Okay, so Brent says use that with a 920 MA for day trading for confirmations. Okay, Jakob, please send us a chart of what you are talking about in the Discord, and I will get to that in a second. All right, Kumba. Let's look at Kumba. I see Nuku is saying let's look at Kumba. Everybody loves Kumba. Yeah, believe it or not, we have a very similar setup. Sorry, I'm just going to load more data. Wow, look at that, eh? How's that for a trend train scenario? Boom, you would have gotten out there though. You would have gotten in, gotten out. So you see that this particular 89-day and add in the buying zone thing doesn't quite work as well as what your 50, 100 and 50, 100, 200 would have worked in this scenario. So let's just change this to 200, right? And we change this to 50, and we change this to 100. Bang. Look at that. There's your buy while your price is, just go to this. There's your buy signal. Ha! Fuck, you missed it, eh? You missed it by like days. That really sucks. That really sucks, man. But nonetheless, I mean, you have this huge... Okay, so let's see if we have a slightly better... let's see if this would have worked. Let's use a 20 and a 40 because this thing is illiquid and volatile. Alright, so there's your first entry on this on the 89-day trend indicator. I'm waiting for a reasonable entry point. Okay, cool, Mohammed. Yeah, so there might be one. I mean, wait for a pullback, wait for an area, you know, between those moving averages or whatever the case is. So here you have your entry, add, stop out. You have another sort of move down below and back up above this. Add, stop out. Again, walking the line. So now you know what's interesting here, right? Is look how this 89-day moving average is supportive of the price. Okay, so this is where a simple moving average is a great support and resistance, dynamic support and resistance level, right? So that's just, so I mean, I think the point here is that there's no one way that is, you know, cookie cutter, one size fits all, but these things have meaning to them. So we can see that this has worked as support and resistance. We can see that we've got long triggers here with take profits, long triggers here with take profits, right? Here we have a short trigger because everything just in the opposite direction. Here we have another long trigger. When we have this movement up through here, that would probably be the one to get you in. This real thrust up here would probably be the one to get you in. So you'd probably get in right at the top of this candle over here. Add in that situation. Remember, we're now using 89, 20, 40. Add in there, add in there. You don't get another opportunity to add, but bang, you get spat out almost. Okay, you missed the top. You never get the top, right? Here we have, boom, kind of like a move down through. So you would add in there, you'd stop out there. So your second position you'd break even on, but your first position you'd make some money on. Then yes, yeah, it chops you nasty. Hey, it just gets really, really terrible. And here we have a proper move up through. Wait maybe for a move back into this thing, but at the same time, not a PC to send chart. Okay, gotcha, Yaku. Okay, I'll read what you said in a second a bit more carefully, and then we'll have a look. And so, you know, maybe wait for a move into this zone. If you find that you're maybe not getting enough opportunities here in this trend to get in and out, maybe change your moving average to 1020 or 10. Let's see what 1020 does. So you can mess with the 1020, you can mess with the 2040, but you don't mess with that 89, because 89 is your trend indicative line, right? So here it would have stopped you out. So this would be, this I would say is no good. I wouldn't use 1020 on Kumba. I would use the 2040. Okay, and with regards to HCL. Okay, cool. So let me quickly read what Yaku says here. I'm just going to move this over here. What is our view on MA channel like a 10 EMA high and 8 EMA low? Long when price close above and stop loss below. Very short term chart like a 5 or 15 minute chart. Okay, so let's use something that's nice and liquid. What is nice and liquid? Naspers. We're going to take that. Oh, yeah. We're going to take that away. Take all of them away. We're going to use EMA. Exponential double EMA. Oh, no, don't want a double EMA. I just want an EMA. And I want 2 of them. And I want a, what did you say, a 10? We're going to make it nice and thick. And a 8. Let's use red. And we use a 5-minute chart. Okay, so this is interesting. So let me just understand here. Oh, index of Forex. Okay. Okay, let's have a look then. Ta-da. Let's use this USD ZAR mini contract. See, I got 50, 100, 200 as my standard setup here. But okay, let's open a new chart so I don't lose my old one. How do I now do this, man? Whatever, okay. I'll just change this one. It's not the end of the world. Go away, go away, and go away. So let's put on a EMA. Okay. And what did you say was it was a 10. We're using it on the closing price, yes. We want to make it blue, yes, go. And we are putting on another EMA. Okay, and we want to use a 8 this time. And we're gonna make it red. Make the circle bigger. Okay, and we're gonna use what, 5 minutes, eh? So here we have a currency. This is maybe not a good currency, so let's use Euro USD as an example. Okay. Collapse that, collapse that, collapse that. Okay, so what is your plan here? Let's see. On an MA channel, okay, so long if it breaks above the 10, long when it breaks above the 10, SL below the 8. Okay, so I'm guessing that this is directional. Or are you using, oh right, hang on, you're using a different thing here. MA. So you're using envelopes actually. Is that what you mean? moving average envelope. Period of envelopes. I don't know what you mean, Yaku. I don't know what you mean. You're gonna have to send me a chart. We can chat about it tomorrow, I guess, if you're not at a PC now. You can send some charts in the Discord. But there's another. This is envelopes. It's a whole different kettle of fish. Moving average envelopes. In any case, so talking about moving, we have to move on because we have been going for an hour and we're halfway. So, okay. Any other questions or anything like that at this stage? I would like to kind of carry on here. So let's look at oscillators, and see, I knew that we would run over. So, what are oscillators? Oscillators are technical analysis indicators that varies, or is a technical analysis indicator that varies over time within a band. So it goes between 2 points. It oscillates either above or below a center line, or between two absolute levels. So a center line being the middle, and it oscillates around that middle, or it has an absolute high and an absolute low, and it sort of ranges in between those two. So oscillators are used to indicate short-term overbought or oversold conditions. Okay, so it is basically a momentum indicator. Oscillators are often used to give trade signals by either moving through set levels on that oscillator, or by making crossovers with their own moving averages, or by generating something called divergence. So an oscillator can be used to indicate divergence in momentum and price, thus potentially indicating trend change scenario. So what that means is that the price, that the direction in which the price is moving and the direction in which the oscillator is moving is not the same, or the strength of the move in either one of those two don't match up, and you have the potential for a potential trend change type of scenario. So to show some examples here, divergence is basically directional. Momentum does not confirm price. So there are four different types of divergence. There is normal bullish divergence and normal bearish divergence, reverse or hidden bullish divergence, or reverse or hidden bearish divergence. Okay, a normal bullish divergence is when the price is making lower lows and the indicator is making higher lows. So I'm going to go through this very study. The prevailing trend in the stock price is down in this case, right? The normal bullish divergence will indicate to us that we have the possibility for the trend changing up, right? So what's happening here is this is a sort of a trend reversal indicator, right? So when the price is making lower lows, but the indicator is making higher lows, or the oscillator is making higher lows, and it doesn't really matter which oscillator it is, right? It can be one of many different ones. Then that is called bullish divergence. Conversely, when the price is in a prevailing uptrend and is making higher highs, but the indicator is making lower highs, that is bearish divergence, and can signal to us that there is the potential of a trade or a trend change on the cards. Now, in both of these, okay, you cannot, when you see these things, you can't use trend following strategies, right? Because these are against the trend strategies. So these are reversal strategies. So when you are looking for like a trend following system, like we were looking at with those 89-day moving average crossovers, or with our 50, 100-day moving average crossover while under 20, once we're looking for that type of, those are trend against the trend strategies. Those are trend change strategies. So those you would use when you see these types of divergence, right? Particularly the bullish divergence. In the case where you're trading, for example, bullish breakouts, bullish flag formations, tests of support levels and then running again, or basically trying to look for an entry point off a moving average following a trend, you could not do those. You should not take those entries when there is divergence present, because you are, if you're taking long entries, don't take long entries if there is bearish divergence, because there is a signal that trend might potentially change. Then there is the inverse or reverse or hidden divergence as well. So what happens is so these are not trend change signals. So the previous two that we've just went through, being the normal and bullish and bearish divergence, these are trend changing signals, right? So the inverse or reverse hidden divergence signals are trend continuation signals. So in this case, you would use trend continuing or trend continuation strategies where you use breakouts and stuff, and our moving average crossover stuff would not work in this case. Okay, so hidden or reverse bullish divergence is basically when the price is making higher lows and the indicator is making lower lows, right? So our oscillator is making lower lows while our price is making higher lows. The opposite to that is when our price is making lower lows and our indicator is making higher lows. Okay, both of these are trend continuation signals. So it shows that the likelihood that the momentum is building into the trend, right? So to give you an idea, the price makes a low here, indicator makes a low. Then the price makes a higher low, but the indicator makes a lower low, which kind of shows that in this movement, there were a whole bunch of down days. So I'll get into how an RSI works now in a second, right? There were a whole bunch of down days in this period, which pushes the indicator all the way down. But in all that time, the price couldn't get below the previous low. When you have a momentum change, when you have a movement change up, and you get a couple of up days coming again, then the stock, the up days, basically what they're showing us is on the down days, it moves down a lot less than what it moves up on the up days. And obviously the converse is true on the bearish side of the coin. All right, I see some of you guys are dropping off. This is very long, so I hope that you come back tomorrow and watch the second half. So the first one we're going to cover is a MACD. So MACD stands for a moving average convergence and divergence, right? So basically it takes two moving averages and turns them into a momentum oscillator by subtracting the lower moving average from the longer moving average from the shorter moving average. So you would usually use, there's a couple of standard ones that you usually use, we'll get into that, but let's say use a 50 and a 10. Then it would subtract the 50 from the 10, and then it would plot that line over time. So what it's doing is it's measuring the distance between the moving averages as they move further apart and come together, okay? So this creates a situation where you have an indicator that's kind of the best of both worlds. One, it indicates momentum in the stock, if that momentum is bullish or bearish, and two, it is a trend following indicator. So when you see the MACD start pulling up above the midpoint or the zero line, or the middle of it, then you know that momentum and the trend is up, right? So there's three ways to crossover there, or to trade this thing. There is the signal crossover, the center line crossover, and then divergence can be used as just explained, right? One of the downsides of this is that it is unbounded, which means it doesn't have upper or lower limits like other oscillators do. Some have upper or lower limits of, lower limit of 0, upper limit of 100. A MACD does not. It is cumulative, and it'll just keep going and going and going until infinity, unless the trend in the stock changes. So basically what it does here is standard MACD is worked out as follows. So a standard MACD is a 12, 26, 9. Okay, so basically what this means is the MACD line that it plots is calculated as a 12-day EMA minus a 26-day EMA. So it's the shorter period minus the longer period, my bad. Shorter period minus longer period. 12-day EMA minus the 26-day EMA. That is your standard MACD calculation, right? And it plots the answer to that on a different chart. And then the signal line is a 9-day EMA of the MACD line. So it's an exponential moving average on the MACD line, which is calculated from the difference between two exponential moving averages. Wow. Eh? And then the histogram that it forms is basically the MACD line minus the signal line gives you the histogram. So let's give you an example of what that looks like. I'm going to remove these. I'm going to change this back to a daily. Give me a stock, give me a stock, give me a stock, guys. I'll use Kumba again because that's the most recent one we got. And we're going to put on a McDonald's. It's not McDonald's. I wonder if there's not a better one. Sorry, I just want to see if I've got a better looking MACD. Apply template. We're going to remove that. Yes. And we're going to look for a MACD. Pop. Okay, signal period 9. Yeah, okay. Display. Yeah. Why must it be so difficult? All right, no. So, let's just see if we got a. Sorry, I'm just looking for a better histogram because this histogram is hard to see. MACD, and I suspect that changing it is going to be more difficult than actually just getting a whole new chart. If I can ever get this right. Let's put on a MACD. Yes. Ha ha. Okay, so let's go Naspers. And we just have to change that. Cool. So let's have a look at this one. Bang. So here we have a slightly better one. What I'm going to do is I'm just going to make these lines a little bit thicker so we can see them slightly easier. Cool. So just to illustrate what we have here again, our MACD line in this case is our blue line, okay, is calculated by taking a 12-day exponential moving average minus a 26-day exponential moving average and then plotting that line. Our signal line, being this red line over here, is taken by applying a 9-day exponential average moving average to the blue line. So you'll see that it's basically a smoother kind of ride, if you would call it that. Then the histogram is the difference between the MACD line and the signal line. Okay, so the standard settings for this is the 12-26-9. And that's why it's called a 12-26-9. You can obviously mess with these. Parameters, but it's not necessarily. But again, you have to. You'll have to figure out what works. Best for you. Yeah. Let me just quickly do that. I want to see something. All right. So now how do you use this to generate trading signals? So you can use a couple of things. As mentioned here, that you can use a signal line crossover. So basically when you have a crossover like here of the signal line and the MACD line, that would be a buy signal, right? Because you have a bullish crossover of those two. That is a bearish crossover, so you would have a sell signal. So I'm going to mark all of these for the sake of, for like ease of reference. Come on. I'm going to mark all of them for us. So there's one. Oi. Okay, it doesn't pull all the way through, but it doesn't matter. There's one. There's one. Da 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 da. This is choppy, eh? Wow. Couple of fake signals in here. Da da da. There's a decent one by the look of things. And there you would be closed. And there you would be short again. And there you would be closed. Okay, so what we have here is this would be a sell signal. Would be here. Then that would be a buy signal. So you would sell, go long. Here you would go short again. And there you would go long again. So this is not working because it is just whipsawing you like a champion. You would go long again here. You would go short again here. You would go long again here. Short again here, probably at the bottom of that candle. Long again at the top of that candle. Short again. Oh, that one's a bit skew. That one should be there. Short again here. You would then go long here for a little bit and then go short here again, and finally you would have a trade that would work out for you. There you would have a long, which would be very short-lived because you'd have a short immediately afterwards, followed by another long trade over here, and finally you have a nice little trending trade again. This would put you short, put you back long, put you back short, put you back long in this little channel here. Here you would be long again, you would be short again, and now once again long. So, I don't know. To me, that doesn't look like the most reliable of indicators. It is mighty, mighty messy. And this is like a string of losing trades, right? Using that. So, okay, cool. Let's not use that then as a... there is a way that I can delete all of these things without doing it one by one, but whatever, I'm just going to do it one by one because I'm a legend. So that doesn't look like it's the most reliable signal. The next way of doing it is to use a center line crossover, right? So a center line crossover is basically every time that the MACD crosses from the bottom up to the top, and then from the top down to the bottom as a buy or a sell signal. So let's go back a little bit here. We're going to ignore that because let's say we start here. There is a buy. The MACD line cuts up from the bottom to the top is our buy signal. MACD line cuts from bottom to top over there. Boom. Okay, so that is our buy. And we would stay long in this thing until we have a cross where it crosses down below again. So now suddenly our buy signals come a lot less regularly, but they seem to be a lot more successful. I mean, just the first one is already a massive trade. Then we have another bullish crossover right over here, which I don't think works so well because we have a bearish crossover over there, and we take a loss on that trade, and we get in short, which we then put in again over here, and which takes us from short to long. So we probably would have lost a bit of money there, but you would have earned a lot of interest on the short. So maybe you would have been able to come out for break even because it's quite a long trade. Here you would go short once again, and then you would stay short up to this point. So okay, we're learning here that this doesn't work so lacquer on the shorts, but what it does do is when you have this bullish crossover and it stays above for a while, up to here, you tend to get fairly decent long trades. So we're going to say let's ignore the short positions, and we only take the long trade. So that one would have sucked you in and spat you out within a couple of days. So there's a long. And I'm doing this with you. It's painstakingly slow and boring, but it's important, I think, that you see how you go ahead and figuring out how these things work, right? And how you go, like, how you test these things and see, learn to trust the system. You want to learn how an indicator works, test it, put it on a stock and look at how it works. So in any case, here you have a short position, right? Boom, that is a beautiful trade because there it closes you. So just as we say, it doesn't work on shorts, it works perfectly. And then there, it would have swung you long again and you'd still be long. So for me, that crossover over the middle is a much more reliable signal than the MA crossover, right? And then obviously you can look at divergence between this as well. Now with divergence on the stochastics, I prefer to use the histograms as my highs and lows, but you can use the MACD line as well. It depends on you. So in this scenario here, let's just see if there is any divergence. There's divergence, right? So you have lower lows, right? I'm going to mark them. You have lower lows. I'm just going to use the real bodies, or you could use the candles tails as well, depends on you. Let's use the tails if you insist, or the real bodies. Either way, it's lower lows, right? And here over the same period you have higher lows. You see that? So you have a bit of divergence there, and remembering what our divergence says, if we have a lower lows and higher lows, that means a potential trend change, right? So going back to our stock price here, we see that, hey, we actually had quite a nice rally after this. So that is potential to, so if you see this, don't take any more short positions, right? Because there is a potential for a trend change scenario. So there are different ways that you can use this indicator, right? Have we got any questions up to this point? I just want to check if there are any. All right, it seems not. So we're going to move on to the RSI, Relative Strength Index. Now, this gets a little tricky. So the RSI measures the speed and change of price movements. This is probably one of the most popular momentum indicators that are out there. And it plots a line that ranges, or plots an oscillator that ranges between 0 and 100. Okay. Actually, I feel like I want to say more stuff about the MACD, but I think what we can do is I can cover that stuff in a catch-up session or something like that, because there is slightly more stuff, but it's fine. I think let's move on because it's already been an hour and a half almost. So okay, so the RSI is probably one of the most popular oscillators other than the MACD. It's probably the most popular momentum oscillator. MACD is more of a trend indicator than what it is. Well, it's a mixture, right? So how is it calculated? So like EMAs, it has to start somewhere, but we'll get to that. So the RSI is calculated by sort of 100 minus 100 over 1 plus RS. RS is calculated as average gain over average loss. Okay. So let me just, sorry, I just now want to just give you the exact. I can't remember what the definition of RS is. Anyway, so 100 minus 100 over 1 plus RS. RS is calculated as average gain over average loss. Okay, so like the exponential moving average, you have to start somewhere. So your first calculation in the series basically just looks at the average loss and the average gain over a 14-day period. So in this first data point of your RSI that we're drawing, your average gain is the sum of all the gains Okay, I don't know where I lost you, so I'm going to start again. The RS is the first data point, right? The average gain, first average gain, is the sum of all the gains, all the up days over the first 14 days divided by 14, and the average loss is the sum of all the lost days over 14 days divided by 14. Okay. I think also that maybe it is important to say here that you use everything, there's no negative values. So losses in this case are expressed as positive values. There are no negative values. Loss times by 13 plus the current average loss today, if there is one, or the closing price if there is one, divided by 14. Okay. And then to work out our RSI, our formula is 100 minus 100 over 1 plus whatever this RS value is that we are calculating. Okay. Sorry, I just keep checking whether the stream is up because I can see that my internet is being weird. Well, my trading platform keeps dropping, and so did the stream a moment ago. So let us look at let us turn up the beat. Let us look at another spreadsheet because spreadsheets are sexy. Dun, da, da, da. Okay, so here we have a number of things. This is an example that I took from somewhere who provides amazing examples. We have some historic data, right? And unfortunately, we don't have many points, but we've got like, what, 33 days or so. We have a closing price, and then we have the change of the day, if it's a down day or if it's an up day, right? So change on the day, and then we've broken that into gains and losses. Okay, so we've only plot the losses here, and we plot the, we only plot the gains on this side, and we only plot the losses over here, right? And we convert the lost days or the down days into positive numbers. So you'll see there it is down 0.54. We change that to a positive 0.54. Here we start working out our average gain. The sum of this formula is, this formula is basically worked out, if you remember, that we look at the sum of the gains over the past 14 periods divided by 14. So we say basically we add all of these together and we divide them by 14. So the formula here is actually later we get to an if statement, but the formula here says sum all of these, because if it's 0 we don't plot it, right? Divided by 14, because that's what we're supposed to use. This is an if statement, so it says that if the change is positive, plot it. If change is not positive, don't plot it, put it to 0. Okay, so our average gain is then 24, and we run that down further. So our second point on the average gain calculation, if you'll remember, is average gain, previous average gain. In this case, that is 0.24, right? Times 13 plus the current average gain divided by 14. Okay, so this 24, right, times 13 plus today's average gain, which is 0, divided by 14, then gives us 0.22. Okay, on the average loss, we are taking the sum of all the average losses over our first 14 periods, and we're dividing it by 14, and that gives us 0.1. The second one, we are taking the average loss, the previous average loss, the one that we just plotted, that we calculated first, times 13, plus today's loss, whatever that may be, divided by 14, and then that gives us our answer. And then that is the formula that we then extrapolate going forward. Okay, and then that calculates our average gain and average loss. Our RS is basically taking those two divided by each other, right? So remember, our RS value that we work out here is average gain divided by average loss, right? So average gain divided by average loss is 24.24 divided by 0.1 gives us 2.39. Okay, and we run that calculation all the way down, right? And we can only start from 14 points onwards. Then our RSI formula, this is now we start using if statements, because it can't be lower than 0 because it stops at 0, and it can't be bigger than 100 because it stops at 100. Okay, but basically what we're doing here is we are taking, and this is actually kind of why we have this 100 in there. So we say 100 minus 100 over 1 plus RS. Okay, so where's my Excel spreadsheet? So here we are saying all right, so we're taking 100. Okay, so now maybe what I should do is explain two things here from the start. If the reading on the RSI is 0, that means that for 14 consecutive days the market has been down, right? If the reading is 100, it means for 14 consecutive days that market, instrument, whatever, has been moving up, right? So we're saying here that if I equals 0, so our average loss is like ZOL, right? Then your indicator should equal 100, because that means that there's no average loss, because over the last 14 days market's only moved up. So then your indicator is at the top, and then the other way around. If it's if it's okay. So anyway, so basically what we're doing is we're saying 100 minus 100 divided by 1 plus our RS value, and that plots our RSI, and we extrapolate that going forward, and then that plots our RSI value. So I hope that the idea you're getting here is that the way that this thing works is it looks at the last number of days, and it looks at the momentum. How many days is it going up versus how many days is it going down? It is also looking at how strong is it going up when it does versus how strong is it going down when it does, versus how many days in a row or over a 14-day period it's doing that. And that gives you what that hopes to calculate, or aims to calculate, the relative strength and momentum and the strength of that momentum in the stock itself. Okay, so what is the practical application of this fancy and confusing equation? So, okay, firstly, this whole equation that it runs here, I've made a note, so I feel I have to say it. This equation that it runs here is a similar kind of smoothing technique that it uses on the EMAs, right? So it kind of makes the lines, that makes the data a bit smoother, so you don't have these jagged, massive movements, right? Anyway, and it ranges between 0 and 100. So if it's 0, it means the price has moved down for 14 periods in a row. If it's 100, the price has moved up 100 periods in a row. So we've covered that. Then, how to trade this, how to use this as a trading tool. So an RSI is considered overbought when it is above 70, and it is considered oversold when it is below 30. Okay, so what people tend to do is that if you have crossovers from below 30 up, that is considered a buy signal, and from above 70 down, that is considered a sell signal. Okay, obviously that's not always going to work. Again, there's no one cookie cutter system that's going to work for everything, but it is an indication to us that it is moving from an oversold position back into a more bullish kind of momentum type situation if we have a crossover from below 30 up, right? So this indicator is just giving us information. It's not making us make a decision. Anyway, so in a trend scenario where something is trending up very strongly, it can remain overbought for long periods of time without changing, without becoming oversold at any point. Okay, so to use this as a entry and exit indicator, it works best in ranging stocks. Okay, so stocks that are ranging between 2 points, if it is in a range, then you find a nice RSI to coincide with the lows, bottoms and lows of that range, and then you could use that as a potential trading indicator. And then triggers are considered as an upward move through 30 or a downward move through 70. Divergence can be used for potential trend changing indicators. Of course, that as well. So let's try and look at a chart to give us an indication. Ha 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 ha. So much of funny. RSI. Relative Strength Index. Pow. Yes, see, this is one ugly looking RSI. Plot. Give us a plot. Let's make it thick. Not that thick, that thick. All right. So what we have here, as you can see in the middle here, we have this little kind of purpley area. So basically what it's done is it's automatically marked off the 70 level and the 30 level. And everything in between that is this fancy schmancy purple that we have going on. Anything above and below that is colorless. And that is a very long hair that just floats around. It's amazing. So when we have movements above 70, we're in oversold territory. When we have movements below 70, overbought territory. When we're below 30, we have oversold territory, right? So we haven't been overbought or oversold in a long time. Here we're overbought, which, you know, we could now say that if we have a movement below 70, that would be a sell signal for us. Until then, you know, there's no real reason to make a move here. So let's move out. There is a situation where, ooh, you see, as you change the data, let's just load data because it makes it more accurate. Boom. Okay, so here we have a situation where, exactly like I was saying just now, it's overbought, kind of comes down, stays overbought, comes down, stays overbought, comes down, stays overbought, comes down, blah, blah, blah. And it just keeps doing that without the actual trend changing. Okay. What is concerning here is that we may have had divergence, because there we have lower highs, but this one takes all of that out and kind of like invalidates it. But we did have that warning coming into this upward trend, but yeah, not really so much of a thing. That I suppose you could say is oversold, but you know, it doesn't really count. That's really kind of trying to cherry pick the very best of the best. So let's have a look. Overbought doesn't really, comes down through. Yes, we have a bit of a movement down. So here we go. Oversold scenario comes up. Trend does stay down for a while and eventually starts to move up. Oh, you can't see that, sorry. There you go. So there's your oversold situation. But again, let's look at this from this perspective. Trend is coming down, and we stay oversold, stay oversold, stay oversold for a very long period of time before the thing actually turns. Okay, so is just using these absolutes, overbought, oversold levels actually helpful at all? Yeah, from my perspective, no. It's very unhelpful because it doesn't actually give us any kind of indication of what's going on. So let's try and use it in a range, because we said it works best in a range, right? Let's see if that works. Where is my, there you go. So in a range type scenario, let's say this is a range. We don't actually breach the overbought, oversold scenarios at all. So let's go to a shorter term time frame. Let's look at a 1 hour. This looks slightly better. Let's just again load data. I think that's all it's going to give me on the daily. I mean, on the 1 hour. So, so here we have a situation where it's starting to look a bit better. We have overbought scenario, comes down through 70, and then it moves lower, 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 lower. That could potentially be something that makes you close your trade. These doesn't really trigger anything here. You have oversold territory around here, moves up, you would buy. I mean, it would punish you, and it would sort of suck you in again and make you buy here, and then you would be long, 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 long until about here, where it breaks above and snaps back down, and that would be breaks above and snaps back down. That would actually be a fairly decent trade, right? So there we have a good one. But in retrospect, it took you out over there, and pow, 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 pow. So maybe again, not the most reliable of ways of using it, or indicators. So Let's look at other ways that you can use it. Obviously, you can use it as a trend identification, or I say the word obviously, it's not always that obvious. So there's something called failure swings. So this is like a break, come back, support, move. So if you've seen this happen on prices before, if you have a support level, for example, I'm going to draw this in. So this is why I don't want to use textbook examples, particularly when it comes to these oscillator stuff, because the textbook example is going to find the one or two things where it works absolutely perfectly, and then you're going to walk away thinking that these things work all the time, and they don't, right? So you have to use real world applications. If you have any other charts you want me to look at, please send them. Vodacom, thank you. Okay, I'll quickly explain this concept. All right, so here we have a resistance level, right? Price comes in, its resistance comes up, breaks through resistance, comes back and tests it, and then breaks away. Now we are going to use exactly that methodology or that thinking with this overbought and oversold level, right? 70 and 30. So we want to look for situations where you have support and resistance in, breaks of this RSI channel, okay? So, boom, boom, that might be one. All right, let's look at Vodacom. Vodacom. Let's go all the way. All right, here's a nice channel. So, unfortunately, we are not breaching our oversold and overbought limits here. So, we'll go even shorter. 30 minutes. Still not, eh? Sure. There's a beautiful range, though, eh? Let's go to 15 minutes. Desperately looking for triggers. Ugh, my back is starting to hurt. So there's oversold. There's a bit oversold. There's a bit oversold. So I suppose that does do a much better job at identifying the highs and lows of this range, right? Touches the bottom is the low of the range, touches the top is the high of the range, touches the bottom is the low of the range, touches the high, sort of indicates the top of the range, and so on. So it does a much better job at identifying the highs and lows. So in a range, on a very short time frame, hey, that seems to be working very well. Let's look at a what we call this failure break or break failure or whatever, failure swings. So here we have a movement up through 70, right? Then we have a break of 70, a move back, tests, holds the resistance level, and then comes back down. So that whole sort of situation there would be our come on, man, why is this so complicated? I just want a circle. Anyway, whatever. This this thing here would be our I will find it. There we go. Burp. That there would be our sort of validated and or sell signal, right? If that makes sense. So you have a movement down through your 70 level, a movement back up towards it, a test, and then a failure of that. So there's your support, or there's your sort of lows that needs to take out. That fails, and then that constitutes as a sell signal, right? So it's not got anything to do with the price, really. And we want similar situations. So here we have a break from below 30, up above it, back to a test, and then a break above this high here. So I'm actually even going to draw that in here, right? Let's not use that. Bang. So there's our movement up from the below 30 to above 30, a retest, and then it takes out that high again, boom, and then that is a buy signal. So let's look over here. That is a buy signal. Okay, it comes back down, tests the 30, and eventually it moves back up. But we would have then gotten in over here. And let's be honest, it wouldn't have been the most ideal entry. Mind you, okay, let's see, we would have gotten in at, say, 114 Rand 20. It traded down 2 Rand 20 against us, and then traded up to 117, where, well, it would have given us kind of like a sell signal here, so we got our break even. If we were maybe more of a trailing stop kind of person, we may have gotten out here somewhere. So it doesn't look like it is the most accurate of things. Here's another one. Well, didn't quite make it below, but we do see at least this sort of test of the 30, bounce, come back to test a little level, and go again. So that could be a long. Yeah, so I don't know. This doesn't look like it's the most accurate thing in the whole wide world to me. So again, it is an indicator and not a complete strategy in a box. Let's use it. It's forever going to work. Yay. Firstrand. Let's have a look at some charts. There is a move up through 30. And that actually worked out quite well. There is a move down. Yeah, that one worked okay. You could put a trailing stop loss on that. There is a move up. And you're hard pressed to find on the daily chart real opportunities with this, eh? So let's move to a 1 hour chart again. Break, retest, go. That one worked quite lucky, eh? That one was quite recent as well. Break, didn't retest, but go. Yeah, that was a decent one as well. That was the first one that got you in. Probably got you out, got you back in. Here's a short. Sort of walks the line, breaks down below. That is a short. And you would have been short kind of all the way till you get a cross up over there again. Or use a trailing stop. Or whatever your risk management system is. Trailing stops are the best, man. I love trailing stops. So yeah, so it depends also on the stock. As we see, it's a bit more successful on Firstrand. I mean, we've got on a 1 hour chart, we've actually had a couple of seemingly okay trades over the last few months. Let's look at something like a 30-minute chart. There is a short, a retest, and a break, right? So that would be put you in there. You could put a trailing stop on there, and that would give you, let's say you shorted there, 64. Yeah, like a rand. It's not necessarily big enough, eh? Break, retest, short, puts you in at about here. That's a decent trade, hey? And interestingly enough here, you've got a resistance level as well. And here you've got that support level. So, oh wait. Here you have your move down through, retest of your 70, come back down, test these sort of lows that it made here, breaks down through that. That's your short signal, right? Over here. So you would get into this trade probably at like this level here. No, wait, let me not do that. Probably, let's say this level here at the bottom of this candle, right? And then you could see that it kind of starts forming a resistance level, doesn't quite make it, so you could then stick around. Where would you put your stop? At the previous high, or ATR times 2, or whatever your trading your stop loss strategy is. And this would have been a really decent trade actually, eh? You could then use that or that as your indicator to get out. So you got to up, break, test, go. So you could have taken there to say there, probably gotten short here again, and then moved all the way down to break of that would have been your out. And this is just using the crossovers of the 1730. Okay, so 30-minute chart on Firstrand. This indicator seems to work nicely. So here we have a stock that we can trade just the signals on this indicator on. Okay, worth testing, worth looking at and forward testing, writing down results, testing it to see if it works, trading it really small. Don't bet the farm. And then obviously trend identification is another thing. So this is the relationship that it has with the 50 level, or the midpoint of that channel. So let's look at where's my thing. So if you draw in here, let's say you draw in this line. Pow. Where we're gonna make it coordinates, and we're gonna put it smack in the middle. We're gonna make it nice and thick, and we're gonna make it pink. Right, so what you can say here is now we can identify trends using our stochastic. It is, as long as it is trading between sort of 30 or below and below 50, coming up and testing this, coming down, coming up, testing this, coming down, coming up, testing this, we say we're in a downtrend scenario. When it is doing the opposite, it's testing the top, we are in an uptrend scenario. See how funny that works? Let's try this on a longer term time frame. Okay, so on a long term time frame, maybe she not so good, because we haven't really got a very, oh, we got a pretty strong uptrend here, but it's like messy, so Firstrand might not be the best indication. Oh wait, hang on. Here we have a situation where the RSI is failing to get above the 50, and we have actually quite a decent downtrend here. And then finally a test, and a break, and a retest, and a up, and we look like we have a trend change scenario here. And then we just have this like sort of bleh, trendless movement going sideways. Well, I guess sideways is a trend. And then we see this RSI starting to really hit 70-30 again. So let's look at Kumba. When we are below 50, we're gonna make this R50 again. 50. It's 50. So we have a situation where we are trending or staying above 50, finding support. The RSI is finding support on the 50 period, and we are in an uptrend. Look at that. Boom, 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 boom. Look at this beautiful uptrend. And we have a RSI finding support on the 50. I'm going to move that a little bit sideways so you can see. Then we have a situation where the RSI is finding resistance at the 50, and we have a downtrend. When the trend starts going sideways, the RSI starts getting its wobble on, and no real indicator, no triggers, no real trend indication. Here it shows that we're in a downtrend. Stock does kind of move down, eventually breaks up. So this seems to work really well, actually. I quite like this. Let's test this on something else. Let's look at Naspers. Yeah. Oh, Nazis. Okay, I'm not going to make it perfect. But do we have a similar thing here? Yeah, kind of, I guess. I mean, here trend stays supported. There's a bit of a fake breakthrough, but kind of stays supportive, and we have a fairly strong up movement here. What happens here is that we have overbought, but the trend is too strong. This does look like, I don't know, this is maybe a bit messy. I don't know, at a stretch I'd be like, oh, this stays below the 50, but it doesn't, it's too messy. So that's not going to work. What does it do with Tiger Brands? Because this was our original stock that we were looking at. Let's just load some data. Okay, below 50 we have downtrend scenarios. Above 50, can we find a situation where it is finding resistance on the 50 and giving us a good trend indication? Not really. So yeah, okay, so again, so on some stocks it works and some it doesn't. I think what the lesson is here is that we have to look at different indicators, and we have to put them on particular stocks and then mess with them and tweak with them until we find something that like really works. And if we see that there's a relationship between an indicator and a stock price, then we can use that indicator on that stock. So what this is telling me is that every stock is going to have a individual indicator, right? So this is kind of the lesson. Like every stock has not an individual indicator, but like every indicator works differently on different stocks. So the RSI works really nicely on Firstrand, we've seen, but it doesn't work so nicely on it doesn't work so nicely on something like, you know, Tiger Brands or whatever the case is. So you have to kind of look at your indicator and curve fit it to whatever stock you're using, be it a moving average, curve fitting it to your stock, be it a RSI or whatever, or a MACD, fitting it into the sort of stock that you're trading, and then seeing what the relationship is between the indicator